Okay, I think it's 11 o'clock. We may as well get going. Our guests this week are the two of the co-managers of Shire Opportunities, so Uzo and Pav. We'll be talking to them later. But in the meantime, there's a bit of news to go through. There's loads of stuff I could have put in here, to be honest. I almost asked Richard to talk about this week's home REIT announcement, or this morning's rather. But yeah, anyway, it's just too complicated. I think I will try and get along to the meeting that they're having about that and try and find out more about it. There's also the AVI winning the Mega Opportunities mandate. That's, I think, good news, and I think it's widely sort of hinted that Nick Greenman's going to turn up there as the manager of that again. But the three that I've picked out are the latest Aberdeen merger, which is kind of like a rehash of last week's merger with the two Asian ones. We've now got Aberdeen Small Companies merging with Shire. And then we've also got Ecofin US Renewables and then Henderson Diversified Income. So those are the two Aberdeen Small Companies income and Shire charts. And as you can see, the smaller companies one, as we know, all small caps have been suffering all the way around the world, really, and UK definitely no exception. And so that's been trading at a discount for some time. Shire's, by contrast, has actually not done too bad a job, and so it has tended to trade around asset value quite often, but not recently. And I don't really know why that would be, to be honest, but there we go. This is how the Aberdeen Small Companies income stacks up within the UK small cap sector. And we did talk about this a bit before when they announced the new strategic review. There are too many UK small cap trusts. It's good to see some rationalisation. So this is all quite a good tick in the box, really. 60 million market cap is a bit on the small side. I don't have a problem, really, with small trusts as long as their charges aren't too high. This one's obviously 1.34, which makes it sort of about 12 for 20 within the sector. But nevertheless, it wasn't really working in everybody's eyes. And you can see that, I think, from the performance statistics here. So over 1 and 3 years in NAV terms, it's definitely down the bottom of the table here. A bit better over 10 years. And this really is reflecting the income bias, which should, because the kind of switch to value, should start to be trying to work in its favour, but hasn't really been happening. The price numbers look a lot better, and that's because of the bounce that we've had since this deal was announced. Shire's income, by contrast, to say that discount is unusually wide. It's normally trading much closer to asset value. Quite an attractive yield, so like 4 for 20 in that group. It's too small as well. So if it could almost, well, not quite double in size by taking all the how many small companies assets, that would be a magnificent thing. I think that's unlikely, though. We'll see how we go. In terms of returns, it's more kind of middle of the pack, but actually over the longer term, more towards the top end, which is obviously good news. The one that we always compare it with is Henderson High Income, and actually performs of the two is relatively similar. It's because they've got quite similar structures in that Henderson High Income uses a bond portfolio to boost up the income, and Shire's income has got a portfolio of preference shares, and that helps boost the income up, which gives a bit more freedom to invest in lower yielding but still yielding income shares, and therefore that actually makes the performance a little bit better over the long term. So the structure of the merger is exactly the same as it was last week. So it's a Section 110 reconstruction, which is effectively liquidating ASCII and flipping it into Shires based on formula asset value, system rather than our discount. But the ASCII shares will be issued to, so that the ASCII shareholders will get Shire shares issued at a 0.8% premium. And that is the way that Shire's protecting its investors from the dilutive effect of what's going on. So that is all kind of reasonable, I think. And they are going to pay out most of the revenue reserves from ASCII ahead of this. Again, we would have to look at the fine print of this to see whether it makes sense or not. And obviously, what you don't want to do is put Shire's in a position where its revenue reserves are diluted. So I'm guessing they're going to think about that, but we'll wait and see. The main difference to last week's is where that was a 25% exit. This is a 100% cash exit opportunity. And I've still got ABD written in there. Obviously, that's ASCII. Yeah, so that is really quite chunky. It helps that Shire has already got a big chunk of ASCII in the first place, which was one of the reasons why everybody thought this was going to happen. So those shares will definitely roll over whatever happens. The managers of Shires won't change, still be Ian Pyle and Charles Luke, with Ian Pyle sort of taking the lead on that. And they're going to transfer about 40% of the portfolio across as stock rather than as cash. And that's because where Shires used to hold ASCII to get small cap exposure, it's now going to have direct small cap investments. And it's also going to aim to have around 20% of its portfolio in small caps post the merger. The other big difference to last week is, remember, where there's a convoluted thing where all the directors ended up on the board and then they whittled them down. In this case, the ASCII directors are all going to step down, which is obviously quite noble of them. So as we said, these are two relatively small funds coming together. So it will help a bit with liquidity and stuff, which is good. If you're an ASCII investor, you get a much higher yield from doing this. It's about a 45% uplift in dividend income, which is probably a big tick in the box. Much lower ongoing charges, which is obviously helpful. Aberdeen is sweetening the pot by waiving the fees on the assets that transfer across, excluding what's already in Shires, which is all good too. I think, though, the only thing is that if you're an ASCII shareholder, you're not being exposed to small cap anymore. And is that something that you're going to be worried about? I've been trying to argue recently that UK small cap is very undervalued, and so therefore getting out of it at this stage might not be great. I mean, you're still going to have some exposure if they have a 20% limit, but still you are going to be losing some of that. So anyway, that's the only thing that I'm slightly negative about. Assuming it all happens, it's going to be October, November. But the good thing is we're going to be able to ask Ian Pyle about it, because he's going to come on the show on the slot that we had free on the 25th of August. So I look forward to you putting some questions to him then. Ecofin US Renewables, we know all about this, has been troubled, and we did talk about this when the manager left, and that triggered the discount opportunity. And then more recently down here, when its wind asset in Texas got hit by a tornado. So the tornado didn't actually take out the wind farm at all. It did take out a couple of transmission poles, but it was more that it hit the substation in Matador in Texas. And that meant that the wind farm couldn't export its power to the grid. So American Electric Power, who are the people behind the grid in that part of the world, are sort of trying what they can to open up a new route to another substation at the town down the road, which is Paducah, Texas. And they think they'll be able to do that by the fourth quarter of 2023. But the capacity of the line won't be quite as big as the one that was going into Matador. So there'll still be some of the output would still be choked off. So they lose about a sixth of it, as you can see there. And they think that the new substation at Matador, which with the full access, will be open within about 18 months. So what does that actually do in terms of Ecofin's finances? So we did cover this in the comment on the note, but on the news story, but I thought I'd just explain it here too. So basically, the insurance cover that Ecofin has got covers 120 days of lost income due to business interruption, but it doesn't apply for the first 45 days of that. And so for this period here, they're definitely going to lose the income. Then they've got a period where the Paducah opens and they get the income, but it's on a sort of reduced basis. And in between it, this period and whenever that opens, they're going to get full coverage from the insurance policy. So maths-wise, the numbers sort of argued there, but what I reckon is that the total hit to the fund can't be more than about $2 million. And that is, I think that's a maximum level, because it's not often that wind farm would have been constantly producing at full power. So we're basing it on what it generated last year, which was about half of Ecofin Renewables income. So that I think the most you're going to lose, as I say there, you use the 45 days and then you lose about a sixth of the power for 375 days. But that might be less than that when it comes out in the works. Now, that 2 million hit, I think, is instructive because the hit to Renew's market cap when this was announced was $12.4 million. So you can see that that drop is way, way overdone. And then it was on quite a big discount in the first place for not very good reason. They've just announced, well, recently announced an NAV of 93.94. So there basically is about 50% upside if it goes back to trading at par. So why might it do that? Well, apart from the manager going, which we know has been resolved since, because we've had Eileen come on the show here and talk to us as well. And the other thing that's been going, obviously, has been the US rate rises. And it does seem as though we are approaching the peak of those. So we had another quarter of percent rise the other day. But talk is, will there be another one in September? Maybe not. Will there be another one at all? Maybe yes. But we are really getting to where the top of these is going to be. So it is possible, I suppose, that rates will plateau and then start to drop. And then you could see a rally and all sorts of things, like especially if it is something like Ecofin. So I just think it looks interesting. There we go. Henderson Diversified income. There's a sort of similarity here in what's going on. They've just announced results. They weren't very good. We just let's put our hands up now and say they're not very good. The NAV fell quite sharply and has carried on falling since. The total return was negative despite the income. The share price fell quite sharply and has fallen a lot more since. The dividend has been flat for a long time to 4.4p, but that works out a 7.1% yield on the current share price. And it's burned through most of its revenue reserves, trying to keep the dividend going as where it is. So the implication is that if they hadn't done that, they might have had to cut that dividend to 4.4, which would definitely wouldn't have gone down well with investors, I think. And again, the problem is the same thing. It's rising rates. You can see that you had a big wobble here around the kind of panic where people worried that a lot of the companies that it owns debt in were going to go bust, and obviously nothing like that really happened. The defaults actually stayed quite low. There's still a bit of a worry about that now, and if we're going to get a US recession or not. But more, it's been that it's held things yielding X, and then the market rate of interest has gone through that, and the value of those loans has gone down, and that's driven down the NAV. And all of that time, the discount's been sort of fairly wide too. So something probably needs to change. Here it is within the sector. So it's not very big now because it has been buying back shares, which is good. But that discount is one of the widest. I mean, these distress test things are disappearing, so maybe they're not worth worrying about. If you ignore those, it is probably the widest thing in the sector to the discount. And in terms of returns, it really is down towards the bottom of the pack over recent time periods, especially in share price terms. Obviously, yeah, as I say, something needs to change. So the chairman put a few comments in his statement. So firstly, he blamed the fact that it was overweight sterling financial bonds in the mini budget, which shouldn't have been a problem since they bounced back again. But yeah, it depends on how they traded those things. I think they probably still got caught a bit. The main thing, though, at the moment seems to be the managers are quite convinced that we are going to get a recession in the well, probably globally, like in the US and in the UK and Europe. And so they are kind of hunkered down, positioned defensively in anticipation of that. So they've been shifting towards high-rated, longer duration investment-grade bonds. and away from high yield bonds. And they think that recession will hit, the central banks will cut rates, and then they'll get the performance uplift from that. The chairman notes that it's a bit too small, which is what we said already. That has an impact on ongoing charges, although they're not too bad really, and also liquidity. It didn't really do what it set out to at the beginning when it was first launched, because I think there was a plan at the beginning that it would have quite a lot of loans within the structure. So it would have investments in bonds, but it would also make direct loans to companies as well. But they haven't really worked because of where interest rates have been. And obviously the board is now focused on the fact that this dividend cover problem is an issue. You can see here how the asset allocation has changed through time. So sometimes it's had exposure to high yield equities, but really that's negligible, and I think probably zero now. The loans bit is virtually 0 to, it's about 7%. And then recently we've had this uplifting exposure to investment grade and down in high yield corporate. And obviously, because at the moment a lot of investors are starting to think actually we might get a soft landing, that high yield stuff has been performing all right, and the investment grade stuff they've been neglecting in favor of the high yield things. So that hasn't really worked. That's the reason it's been holding up performance. So the sum of all this is that the board is saying something's not right here. We've got to have a big rethink. We don't know what we're going to do, but we are effectively sort of going back to the drawing board and saying, is this the sort of fund that we should be running, or do we need to tweak the strategy in quite a kind of major way? So it's going to be interesting to see what happens there. It's not as strong as saying, if you've got a better bond fund than us, come along and pitch for it. But it might trigger that. We're just going to have to wait and see. It might just be that we get a tweak. But obviously the big question here for this one versus Ecofin US is whether we are going to get this recession and a hard landing or not, or whether we actually things get okay. And talking to another manager this week, he was saying that there's a big shift between between equity investors who seem to think there's a soft landing coming, and bond investors who tend to think there's a hard landing coming. So we're just going to wait and see. One quick question before we go over to our guests. So Stephen was saying, is Aberdeen trying to reduce his investment portfolio? I do think, because there's been an awful lot of activity going on, that they've been encouraging this in the back. That they had 21 funds at the start of the year. Aberdeen Latin American Income's gone already. We've seen the Asian merger, this merger today. ADIG's obviously got a strategic review. There's a lot going on, but I think it's trying to reduce it to a core of stronger funds. So it's sort of like housekeeping, I think, rather than anything drastic. Hope that helps. Now